Have you ever looked at your bank account in January and thought, how did this happen? Not because of a major emergency or unexpected bill, but because of dozens of small, easy to miss choices that added up. The truth is, some of the biggest financial setbacks aren't dramatic. They're legal. They're common. And most importantly, they're preventable. As we turn the page to 2026, it's the perfect time to reflect, reset, and avoid 5 money mistakes that drain your finances and add unnecessary stress. Let's walk through each one, along with simple ways to avoid them, so you can move into the new year with more confidence and clarity. Mistake 1: overspending after the holidays. It usually starts with love and good intentions, thoughtful gifts, travel to see family, maybe even saying yes to one more holiday event. But come January, many people find themselves facing the reality of a drained checking account and ballooning credit card balances. Financial advisors call it the January hangover. The spending felt joyful in the moment. But the consequences show up when the parties are over and the bills arrive. Think about it: if you charged $1,000 on gifts, travel, and extras, and only paid the minimum, you'd still be paying for this year's holidays by the time next December rolls around. And with interest, you'd be paying even more. So what can you do? If you overspent this season, don't panic. Start by reviewing your total. Break it down by card or category. Then create a basic plan to repay it. Even $50 a week can chip away at the balance faster than you think. You might try a short-term no-spend challenge in January, skipping takeout, pausing new purchases, or temporarily cutting back subscriptions. And most importantly, think ahead. Could you set aside $20 a week starting in February for next year's holiday budget? Small, consistent actions now can prevent stress later. Mistake 2: starting the year without a budget. A new year without a money plan often leads to repeating last year's financial stress. Without a budget, it's easy to feel like your income disappears. One month it's spontaneous dinners. Another month it's unexpected bills. Either way, there's no clear picture, just a vague sense of always being behind. A budget doesn't have to be complicated or restrictive. In fact, a good one gives you more freedom, not less. Start with your take-home pay. Then write down your essential expenses: rent or mortgage, groceries, utilities, transportation. Next, look at flexible spending, things like dining out, shopping, entertainment. Are you spending more than you earn? Or is there a gap you can direct toward savings, debt payoff, or future goals? You don't need an app or spreadsheet if that feels overwhelming. A notebook works fine. The key is making your money intentional, not accidental. Ask yourself, when was the last time I gave every dollar a job? That one habit can reduce stress and bring clarity to your finances in a way few other things can. Mistake 3: holding on to high-interest debt. High-interest debt is a financial slow leak. It doesn't feel urgent, but it quietly drains your money month after month. Credit cards are the most common culprit. If you carry a balance, you're likely paying 20 to 25% interest, or more. That means a $1,000 balance could cost you $200 or more per year, just in interest. Now imagine carrying $3,000 or $5,000 for several years. That's thousands of dollars lost, with nothing new to show for it. If this sounds familiar, you're not alone. Millions of Americans carry high-interest debt, often for years. The good news? There's a way out. Start by choosing a repayment method: the snowball, pay off the smallest balance first for momentum, or the avalanche, pay off the highest interest rate first to save the most money long term. Whichever you choose, the goal is the same: pay more than the minimum. Even an extra $50 a month can save hundreds in interest and shorten your timeline significantly. Also, consider calling your credit card company to ask for a lower interest rate. You'd be surprised how often they say yes, especially if you've been a long-time customer. Remember, every dollar you put toward high-interest debt is buying back your freedom. And that's a goal worth prioritizing. Mistake 4: not having an emergency buffer. Life doesn't always follow the script. Cars break down. Jobs change. Medical bills show up. That's why having an emergency fund, even a small one, is one of the most powerful tools in personal finance. Yet nearly 60% of Americans don't have enough savings to cover a $1,000 emergency. That means even a minor surprise can lead to debt or delayed bills. If you've ever had to put a car repair or urgent expense on a credit card, you know how fast it adds up. So how do you start? Begin with a small goal: $500 or $1,000. Set up a separate savings account and automate a transfer from each paycheck, even if it's just $20 or $40. Call it your peace of mind fund. Because that's what it is. Once you hit your starter goal, work toward 1 month of expenses. Then 3. But don't worry about hitting a perfect number right away. The act of building the fund, even slowly, creates stability. Because the next time life throws a curveball, you won't panic. You'll have a cushion. Mistake 5. Skipping retirement contributions. It's easy to focus on today's bills and put off long-term planning. But skipping retirement contributions, even for a few years, can make a big difference later. Time is the most powerful factor in growing a retirement fund. The earlier you start, the more your money has a chance to compound. Here's the good news: you don't need to contribute a huge amount to get started. If your employer offers a 401k match, aim to contribute at least enough to get the full match. That's essentially free money. If you don't have a retirement plan through work, consider opening a Roth IRA or traditional IRA and contributing what you can. Even $50 or $100 a month makes a difference over time. The key is consistency. And if you stopped contributing in the past, don't feel discouraged. Start again now. Future you will be glad you did. As we step into 2026, these money mistakes are worth paying attention to, not because they're rare, but because they're so common. The good news? Each one has a simple solution. You don't need perfection. You need a plan. So here's your challenge: pick just one of these habits to focus on this month. Is it reviewing your budget? Building your emergency fund? Finally making that debt payoff plan? Start there. And if this video helped, let us know in the comments, which mistake are you avoiding in 2026? Don't forget to like, subscribe, and tap the bell for more calm, practical personal finance tips every week. Thanks for watching, and Happy New Year!